If you woke up this morning and you said to yourself, I need to know how my Social Security benefits are going to be taxed, boy, do I have a video for you, because that's exactly what we're going to be talking about today. Social Security and how your benefits are taxed. I'm going to show you some examples. We'll go through some key concepts and things you need to know to see how it's going to work. And then from there, I'll show you some big planning items in terms of, hey, what does this all mean in terms of the grand scheme of putting together a retirement plan? So with that said, let's just jump right in. So what we're going to do is we're going to look at 6 different scenarios that all go through different levels of income to show you how more and more income affects your Social Security and how it's taxed. But before we go through these 6 scenarios, what we first need to do is define provisional income, which is really, really important. So provisional income is half your Social Security benefits plus all other outside sources of income. A little more to it than that, but for the sake of keeping things nice and simple here, that's basically what it is. So now we know what provisional income is. Let's jump over to our scenarios or different examples. Number 1 on the far left-hand column here, $22,000 of Social Security benefits. Well, we put that through our provisional income here. We could see that's $22,000, half, which is $11,000. Adding in all other outside sources of income. In this scenario, we don't have any other outside sources of income. So we are in the less than $25,000 bracket here, which means 0% of our Social Security benefits are taxed. Just like it says here in scenario 1, taxable Social Security right here, $0. Perfect. Let's move on to scenario 2. Same thing, $22,000 in benefits in every single scenario. So in this one, we're just adding on $14,000 of IRA distributions. This person's taking out $14,000 from their pre-tax IRAs. So running it through the provisional income calculator here, we'll see it's half of $22,000, which is $11,000, which is always what we start with. We add on our outside sources of income, which is $14,000 in this case. $11,000 plus $24,000 is $25,000. We take that number and we throw it into this chart here. We'll see that we're just right at the top, less than $25,000. So we're still in this 0% bracket, which is perfect. Which means we get back to our examples here in scenario 2, which we're looking at here, still $0 of taxable Social Security benefits. So fantastic. But something happens in scenario 3. We crossed over into the second bracket here, the $25,000 to $34,000 bracket here, which means 50% of every dollar that is in that bracket is subject to federal income taxation. So we're $1,000 over, because if we do our provisional income calculation here in scenario 3, half of $22,000 is $11,000. Add in the outside sources of income, which is $15,000. That puts us at $26,000. Well, we're only $1,000 into the second bracket, so it's only the amount that's in this bracket right here that we have to use for our formula here. So $1,000, it says up to 50%. So 50% of 1,000 is $500, like it says right here. So when this person's filling out their 1040 here, they're gonna have $15,000. That's gonna be from their IRAs, and $500, that's gonna be from their Social Security benefits. And you can see that. We can collapse this here. You can see total income from scenario right here. Total income, $15,500 from scenario 3. And in scenario 2, all they had were the IRA distributions, and none of their Social Security benefits were taxed. So just the $14,000 from the IRA. What's really interesting, though, is that as we start to get into this second bracket here, the $25,000 to $34,000 bracket, because this is a single filer, what's really important to know is that, look, we added on $1,000 of income from scenario 2 to scenario 3 that you could see here in total income, but it added on $1,500 of income. And the reason for that happening is because, number 1, we're adding on $1,000 of IRA distributions, but we're also adding on $500 of taxable Social Security benefits. So in a sense, it's almost like your marginal dollar for every dollar that you're adding on an income when you're in this bracket, in this case here, you're adding on a 50% kind of like kicker to your taxes. So instead of this person being in the 10% bracket, like it kind of says here, they're kind of, I can scroll down here a little bit, kind of in the 15% bracket, like it says here, because the next dollar or the next $1,000 right here in ordinary income is actually being taxed at 15%. So something to kind of be aware of. So looking at scenario 4 now, we can pretty much keep filling up this second bracket until we get to $34,000 of provisional income, and that's exactly what happens in scenario 4. If we look at our provisional income, 22,000 divided by 2 is 11,000. Add on 23,000 for scenario 4. 11,000 plus 23,000 is $34,000. That puts us right at the tippy top of that second bracket, which is up to 50%. Once again, this is not a tax rate. This is just trying to determine how much of your benefit is subject to federal income taxation. So 34,000 minus 25,000, because it's all the money that's in this bracket, that's $9,000. You take 50% of that. 50% of 9,000 is 4,500, which is exactly what it says here in scenario 4. Once again, though, you want to see how that affects your bottom line. You've got in scenario 4, $23,000 of IRA distributions. Of your $22,000 in Social Security benefits, only $4,500 is taxable. So this person should have $27,500 then total income. That's exactly what it says here in scenario 4. Moving on to scenario 5. This is where things get really spicy. So this is where we get into the third bracket here. Now we're going to have more than $35,000 or more than $34,000 in provisional income. We will see that this person has $22,000 in Social Security benefits. Divide that by 2. Add in outside sources of income. It's $11,000 plus $24,000. That's $35,000. Remember, it's only the money that is in these brackets that is being used to calculate how much of your Social Security benefits are subject to taxation. So we still have $9,000 in this 50% bucket here, but now we have $1,000 that's in this 85% bucket. So $35,000 is our provisional income. We're only $1,000 over in this third bracket. That means 85% of that $1,000 is subject to taxation. So $4,500 plus $850 in the second bracket, or this third bracket, I should say. And we have a total of $5,350 of your Social Security benefits that are subject to federal income taxation. Once again, we could go down here in scenario 5 and look at the difference or the addition of $24,000 plus $5,350. We could see that is $29,350 right here that is subject to federal income taxation. Let's move on to scenario 6. This one is the last one because of the fact that we've reached our cap. Once you get to the point to where 85% of your benefits are being calculated, you'll never have more than that that's subject to federal income taxation. So in this case, 85% in scenario 6, 85% of $22,000 is $18,700. We took half of $22,000 in determining our provisional income. We took half of $22,000, added on $40,000. That puts us at $51,000. Well, that's way above this. $17,000. You run through, you do $17,000, you do 85% of $17,000, which is the difference between $34,000 and $51,000. That's how I got that $17,000 number. You take 85% of that, plus, remember, we're still taking the $4,500 from the second bracket here, and the answer is more than $18,700. So once you get to that point, doesn't really make a difference in how much income you add when it comes to how much of your benefits and Social Security are taxed. So this person could, I could go back to the screen share and I could change this to, 55,000. It's not going to change how much of our benefits are taxed. It's always going to stop at $18,700. They kind of reach their cap. And this is obviously going to be different for every single person. But in this case, being that they have $22,000 in benefits, $18,700 is the most that is going to be subject to federal income taxation. Now, this is going to change every year, of course. Right now, they're getting $22,000 in benefits, but next year, they're going to get a COLA increase. They're going to get a tiny bit more. This $18,700 is going to increase a tiny bit. So every year, you kind of have to run through these numbers and see what the difference is. So what are the takeaways here? What can we, take away from a retirement planning standpoint and a strategy standpoint? How can we use what we just found out when it comes to Social Security benefits and use it to our benefit? Well, the first one is, you could see how easy it is to really get to that 85% cap. In our case, it only required $40,000 of outside income from IRA distributions and from really anything else. I just used IRA distributions as an example, but you could use bank interest or dividends from a brokerage account, and you could get to that 85% number pretty quickly. And the reason for that is those brackets that we looked at for provisional income, those haven't gone up since like the 80s. They're not inflation adjusted. Those don't change every single year. That could change in the future, but for now, that's pretty much how it is. But the big thing I would take away from this is really think about when you want to take your Social Security. Does it make sense to delay now that you saw how Social Security is really taxed? Opens up the door for a couple things if you delay. In our example, let's say this person was taking Social Security at 62. Well, if they delay all the way to 70, basically they're going to have this retirement valley of income, because if they don't take Social Security till 70 and they retire at 62, well, they're not going to have any other sources of guaranteed income between 62 and 70 unless they have maybe a pension or are already taking an annuity. But assuming outside of those, which most people don't, they're going to have this opportunity to do things like Roth conversions or something like capital gain realization. The Roth conversion opportunity, of course, is you're moving from your pre-tax in a lower tax bracket into the Roth money that all grows tax-free in the future. And then with capital gain realization, of course, you are taking advantage of potentially a 0% tax bracket if your income kind of stays low enough in those 62 to 70 years. So definitely some opportunity for some tax planning if you delay from 62 to 70. And then, of course, if you delay from 62 to 70, you get a bigger benefit. The downside, of course, is always, when it comes to Social Security, I feel like when you take your benefit, it's a very, very personal decision. There's not really a numbers reason as to why you take Social Security. I don't think there's anything wrong with that. You've been paying into it for decades, multiple decades, and you're saying to yourself, I want to take this benefit as soon as possible because I've been paying into it for so long. I'm not going to fault you. Totally understand that. But there are some opportunities for planning-wise, tax-wise, if you wait from 62 to 70 and you end up living till, 85 plus. That could be an opportunity and something to kind of think about long term. I mentioned Roth conversions super briefly, but if you want to know more about what they are, click here and I'll explain how powerful they really are in retirement. I'll see you there.